In trading, there's this idea that you need complex systems to make money. But what if the exact opposite were true? Today, we're going to break down a super boring, rule-based strategy that promises something way more valuable: consistency. Let's dive in.
So, the person behind this strategy kicks things off with a really bold claim that being boring is the secret to consistent wins. I mean, that completely flies in the face of the fast-paced, high-action trading world we always see online, right? It kind of makes you think, maybe the secret isn't excitement. Maybe it's discipline.
And that really is the core question, isn't it? So many traders, maybe even you, have gotten totally lost in a mess of complicated indicators and fancy systems only to end up losing money. So could the answer really be something this simple? Well, we're about to find out.
Okay, so this is called the first candle strategy. And its real power is just how simple it is. We're not trying to juggle 5 different charts or a dozen indicators here. It's all about focus. One setup on one time frame at the same time every single day.
And this is the whole philosophy behind it. The idea is that good trading isn't some chaotic, exciting gamble. It's actually more like a methodical exercise. It's all about mastering one single repeatable process so you can take all the emotion and all the guesswork out of the equation. All right, so how does this thing actually work? We're about to walk through the exact blueprint step by step. And don't worry, it's broken down into 3 super clear, super actionable steps.
The whole process really just boils down to these 3 things. First, we mark our levels. Then, we patiently wait for a very specific entry signal. And finally, we set our risk and our reward. That's it. Simple. Now, let's get into the nitty-gritty of each step.
Okay, step 1. This is super precise. You're going to pull up a 5-minute chart right at the market open. That's 9:30 a.m. Eastern Time. The second that first 5-minute candle closes, you just mark its high and its low. That's it. Those 2 lines create your trading zone for the day.
All right, now for the entry, and you really got to pay attention here. This is a 2-part trigger. First, you need to see a candle actually close outside of that range you drew. But, and this is so important, you don't jump in yet. You have to wait for the price to come back and retest that level. This patience is what filters out all the noise and helps you avoid those classic fakeouts.
And last but not least, we've got to manage the trade. Your stop loss, that's your safety net, goes right in the middle of that first candle's range. Easy enough. Then your profit target is set to be twice as far away as your stop loss. That gives us a 2-to-1 risk-to-reward ratio. Let's talk about why that ratio is such a big deal.
So what does a 2-to-1 risk-to-reward ratio actually mean? Well, it's pretty simple. For every $1 you're willing to risk, you're aiming to make $2 in profit. This is an absolute game changer because it means your winning trades are twice as big as your losing ones. You can actually be wrong more often than you're right and still be a profitable trader in the long run.
Okay, so knowing the rules is one thing, but honestly, knowing what not to do is just as important, if not more so. So let's cover the 2 biggest mistakes that can completely wreck this strategy if you're not careful.
The number 1 killer is impatience. We all know it as FOMO, right? The fear of missing out. You see the price breaking out, your heart starts pounding, and you jump in because you're terrified of missing that huge move. But listen, that impulsive entry is just a recipe for taking senseless, frustrating losses.
I mean, just look at the difference here. It's night and day. On the left, that FOMO entry gets you trapped when the price snaps right back. But on the right, the patient trader waits for that retest. That retest is your confirmation. It tells you the old ceiling is now the new floor, and that gives you a much, much higher probability trade.
Now, the second mistake is a little trickier, a little more subtle. It's trying to force a trade when the market just isn't going anywhere. If you see the price poke above the high, then immediately drop and poke below the low over and over again, that's a choppy, consolidating market. And in those conditions, the best trade you can make is no trade at all.
And check this out. This timeline shows you exactly what that looks like in real time. For over an hour, the market is just a mess. Impatient traders are getting chopped to pieces trying to guess the direction. But the disciplined trader, they just sit on their hands and wait until a clean, valid signal finally shows up. Patience pays off.
So, we've got the rules, we know what not to do, but it all comes down to the million-dollar question, right? Does this boring strategy actually make money? Let's take a look at the results from a 1-month backtest.
So get this. Over a full month of testing, the strategy had a 70% win rate. Just think about that for a second. Out of every 10 trades, 7 of them were winners.
And when you combine a high win rate like that with a strategy where your wins are twice as big as your losses, well, the results can be pretty incredible.
And we're not talking about just a couple of lucky trades here. The setup showed up 20 times over the course of the month. That's basically an average of one high-quality trading opportunity almost every single day. That's what we mean by a consistent, repeatable process.
So, what's the bottom line? The big number? A net profit of $10,000. And get this, that's from trading just a single contract on the NASDAQ. It just goes to show you the real, tangible result of sticking to a disciplined, boring, and repetitive plan.
All right, so here's the full breakdown of that backtest, which is just testing the strategy on old data to see how it would have done. We've got a 1-month period, 20 trades, that awesome 70% win rate, and the $10,000 profit. The source also points out a low drawdown, which basically just means there were no scary big drops in the account balance. That kind of stability is huge for a trader's confidence.
And really, this brings us full circle, right back to the main idea. The message couldn't be clearer. The goal isn't to be entertained, it's to be profitable. And according to this strategy, you find that profitability through discipline and consistency, not complexity.
So I'll leave you with this question. In a trading world that is absolutely obsessed with complex systems and the next shiny indicator, what kind of power could you unlock by just focusing on and mastering one simple, repeatable process?